Hello, everybody. Adam Bergman here, tax attorney and founder of IRA Financial. On today's video, everything you need to know about Roth IRA conversions. So we are living in the golden age of Roth IRA conversions. Yeah, we are. Why? Because prior to 2010, if you had above $100,000 in annual income, you are not permitted to do a Roth IRA conversion. So since that time, we are now in the golden age of Roth IRA conversions. Why? Because anyone, irrespective of their income levels or net worth, can do a Roth IRA conversion. So on today's video, I'm going to do the following. I'm going to, number one, explain, of course, what a Roth IRA conversion is. 2, talk about some of its benefits. And then 3, talk about the strategies involved to determine whether you should engage in a Roth IRA conversion. So, first part. What's a Roth IRA conversion? What is it? So it's actually pretty simple. All it means is you take a pre-tax IRA and you convert it to Roth. So what's a pre-tax IRA? A pre-tax IRA is an IRA that you've set up, whether it's through contributions to an IRA, or maybe you had a former employer 401k plan that you rolled into a IRA. But essentially the primary characteristics of a traditional IRA is you got a tax deduction by making the contributions. But as a result of getting a contribution deduction, you are going to pay tax when you pull the money out. And the tax rate is obviously based off your income tax level. But if you're over 59.5, it's ordinary income tax. But if you pull the money out prior to 59.5, you're going to pay ordinary income tax plus a 10% early distribution penalty. So essentially, the government is trying to encourage us to save, which is great. But the advantage of the pre-tax IRA is you get that income tax deduction, which is great. Everyone wants deductions. It reduces the amount of tax you have to pay. The downside is when you pull the money out, you pay ordinary income tax, not capital gains tax, but ordinary income tax on what you pull out. Now, what's a Roth? 1997, Roths were created by Sarah Roth of Delaware, and it's essentially the flip of a traditional IRA. You do not get a tax deduction for making Roth IRA contributions. 2023, just like a traditional IRA, you put in $6,500 or $7,500 if you are over the age of 50. You obviously need earned income to make pre-tax or Roth contributions. So it needs to be W-2, 1099, sell a widget, provide a service. If you just generate capital gains, dividends, rental income, royalties, interest, those passive categories of income are not deemed earned income and are not available for contributions. Meaning if you are retired and play golf all day and all you have is your investment income or Social Security income, you're not going to have any earned income to make contributions. Now you can piggyback off a spouse if he or she has ample contributions, but those are how the rules work. So for a Roth IRA, same thing. There's earned income requirements. However, for a Roth IRA, if you make more than $253,000 married filed jointly, or $228,000, married filed jointly, and $153,000 if you're a single filer, technically you make too much to do a Roth IRA contribution, right? So you're saying, oh God, I make $300K. You're saying I can't do a Roth IRA contribution, Adam? Well, no, there's always workarounds. Something called a backdoor Roth IRA, where you simply make an after-tax IRA contribution. So you open a traditional IRA and you put money into an after-tax IRA. Essentially, you don't take the tax deduction for making that IRA contribution, and then you immediately just convert it to Roth. And since 2010, there's no income limitations for Roth IRA conversions. Therefore, you just took an after-tax IRA contribution of $6,500 or $7,500 or $2,000, $3,000, whatever you elected to contribute. and you just convert it to Roth. And since it's after tax to Roth, there's no tax on that contribution conversion. If it was pre-tax to Roth, as I mentioned earlier, you would pay ordinary income tax on what you convert. The one caveat to this is if you have other pre-tax IRA contributions and you want to do a backdoor Roth IRA, there's a pro rata formula that will not allow you to convert the whole amount of the backdoor Roth IRA contribution. So here's a very simple example. Let's say you had a pre-tax IRA from years past and now it's worth 5K. And in 2023, you make 500K, so you can't do a backdoor Roth. But you still want to do Roth, right? We all love Roth. Why? As I mentioned, once you're over 59.5 and the Roth's been open 5 years, it's all tax-free. Well, if I didn't mention them, I'm about to get there in 1 second. So we all want to be Roth. Okay, and I'll talk about in a couple minutes the advantages of doing this conversion and whether it suits you or not. The question is, okay, I have this $5,000 IRA. I make 500K a year. I really want to go back to a Roth. I want to do a Roth. Can I do it? So I put in $5,000 this year into an after-tax IRA, and then I convert it to Roth. The issue is because I have a pre-existing pre-tax IRA, only half of what I convert will go Roth. The other would be subject to tax. Why? Because you have to take the $5,000 of pre-tax IRA I had before and take the $5,000 backdoor I want to do today. 5,000 plus 5,000 equals 10,000. And if you want to do backdoor of 5 over 10, that's 50%. Therefore, 50% of the $5,000 I'm going to backdoor would be Roth, and the rest would be subject to tax based off the previous contribution. The idea is the IRS just needs to account for what you did in the past, and they don't want you to piggyback what you can convert. And then that formula will just continue. So again, pre-tax IRA, the advantage, you get the tax deduction. The money grows within the IRA tax-free, which is known as deferral, which is awesome. But once you pull it out, if you're under 59.5, income tax plus a 10% penalty. If you're over 59.5, just income tax on what you pull out. A Roth, the advantage of the Roth is once you're over 59.5, the Roth's been open at least 5 years, everything you pull out is tax-free. If you pull money out prior to 59.5, the contributions you can always pull out tax-free. So what you contributed to a Roth IRA, since it's after tax, you can always pull out tax-free. The earnings on that contribution, meaning the investment gains on those contributions, if you pull it out before 59.5 and the Roth's been open 5 years, income tax plus a 10% penalty. So again, it's super important if you are doing a Roth IRA. This is liquid gold. This is so important. It's potential tax-free income, tax-free distributions. You really want to preserve the Roth characteristics, and you really, really want to wait till you're 59.5. The Roth's been open at least 5 years to pull it all out. Now, as I mentioned, contributions can be pulled out tax-free. So let's say over the last 10 years, you made $5,000 contributions. That's 50K. And over those years, that 50K is now worth 500K, right? You did really well. You made some good investments. You're super smart. So, and let's say you have a cash crunch. You need some cash. Well, even if you're 45 years old or 32 years old or 56 years old, the 50K of those contributions, 10 years, $5,000 a year, you can pull that out anytime you want. Okay. So that is super valuable. The earnings, right? That 450K of earnings, right? 50, it's now worth 500, it's 450 in earnings. For the 450 to preserve the tax-free characteristic of it, you need to wait your 59.5 and the Roth's been open at least 5 years. Okay. So that's the difference between contributions and the earnings on the contributions. So obviously, first thing, why do you want to go Roth, right? Why do you want to convert? Obviously, you want to take pre-tax income and turn it into tax-free income, right? That's the game, right? So you're 45, you're 50, you're 55, you're 25. You have all this potential growth down the road that you don't want to pay ordinary income tax on, right? Because you may have millions of dollars. And if you can convert it to Roth at a lower value, you just hit the home run, right? That's for tax lawyers, that's the ultimate prize. That's our Super Bowl. where you can defer taxes and then shelter any future taxes, right? That's what it's all about. That's what is winning the Super Bowl for a tax lawyer, is helping your clients defer taxes and ultimately sheltering it. It's the first thing you learn when you start studying tax in law school. Is the two key principles is defer tax, right? Because your money grows faster when it's not subject to tax. So defer it and ultimately shelter it if you can. The Roth IRA is the best legal tax shelter out there. Other than life insurance, it's the best legal tax shelter out there. Why? So long as you're 59 and a half, the Roth's been open more than 5 years, you literally can pull everything out tax-free. So should we all do Roth conversions? Listen up. I'm going to tell you if it works for you. So the first thing to consider is your age, right? Someone who's 25, a Roth conversion has a lot more value than someone who's 85. Why? It's a lot more potential years to grow those funds, but it may not necessarily be the case. And that's why I'm going to keep saying it's facts and circumstances. Let's say you're 85 years old, okay? You have this investment in this private company. Maybe it's only worth $50K now, but there's a very good chance in 2 years, Google is going to buy it for $100 million. And then that $50K may be worth $5 million. Even if you're 85, doing a Roth conversion today makes sense. Yeah, you're going to have to wait 5 more years after you convert to lock in the growth. But you may say, you know what, I may not be around. My spouse will. And if my spouse isn't, my kids will be. And they're going to potentially have $5 million tax-free. That's an unbelievable legacy. Yes, they'll have to pull those funds out within 10 years, but it'll all be tax-free. I'm not going to be leaving them income that's subject to 35% tax. I know that if this company ends up getting sold in the next year, 2 years, 3 years, 4 years, 5 years, and even if I'm not around, I'm gone and my spouse is gone, my kids will enjoy that money and they'll have 10 years to pull those funds out tax-free. So it's not always true where you have to be young to take advantage of a Roth conversion. It's really all based off value, okay, and how much value you believe your investment will have. So the first thing is age. Second thing is, can you pay the tax on the conversion, right? If you're 45 years old, you got to convert 500K and you don't have $150,000 to pay tax on, yeah, maybe the conversion doesn't make sense. Some people may say, well, just take the conversion and pull the money out to pay the tax. Doesn't work. If you're under 59 and a half, it's not going to work. You're going to pay tax and 10% penalty on what you pull out. Over 59 and a half, it could work because the converted amount is not going to be subject to a 5-year lockup where it's subject to tax and a 10% penalty. So if you do a Roth conversion at 45, okay, you still got to do a 5-year window and be 59 and a half for each conversion you do. If you're over 59 and a half, you don't need that 5-year window to pull out what you convert, okay? You need the 5-year window still to pull out the earnings, right? So the conversion rules have a different 5-year rule than if you just did contributions. If you do contributions to a Roth IRA, once you're over 59 and a half and the Roth's been open 5 years, even if you put $1 in when you're 18, you're going to satisfy that 5-year. But for the conversion, there's a 5-year window for each new conversion. So if I do conversions every year at 59 and a half till I'm 70, each year I have to do another 5 years for that amount contributed. I'm over 59 and a half, so I can pull out whatever I converted tax-free. But the earnings, the juice on those conversions, each time I convert, there's a new 5-year window lockup for those converted amount in order to get the earnings on that contribution converted amount tax-free. So the ability to pay, right? You may have net operating losses. Maybe you were out of work for 8 months this year and your net income is going to be low. You can always look at your tax bracket. Hey, I got a little bit more. I got 80, 70 grand to push to stay in the same tax bracket. I'm at the 24% tax bracket. Even if I convert 70 or 80K, I'm still going to be in that same tax bracket. I'm good to go. Or you may say, I can't convert more than that because I'm then going to go 24 to 30%, and that's just not going to work. Or you maybe had a lot of losses or credits or deductions. That makes sense. Now, if you're over 59 and a half and you convert, you could pull some of those funds you convert out of the Roth to pay the tax. But again, you got to remember that you're pulling money out of this very, very valuable stream of tax-free income to pay Uncle Sam. And sometimes it doesn't always work. There's a nice strategy I'm actually doing a podcast on. I just taped it. It should go live in the next week or so, where there's strategies where, for example, you could end up doing a Roth conversion and then engage in an oil and gas investment with personal funds. And what an oil and gas investment does is it generates a lot of immediate tax deductions because of how the tax rules work for depletion and amortization of some of the tangible drilling costs. If you invest 100K, you can potentially get 40-50% of deductions in the first year. So it's an interesting strategy, which I'll talk more about at other times, where let's say you convert 60K or 80K, and then you invest maybe 50 or 60K of personal funds, not retirement funds, personal funds into an oil and gas investment to generate very, very large immediate deductions in the year of the investment, which will offset to a significant amount the tax owed on the conversion. So that's a really cool strategy where you do a Roth conversion and then invest personal funds into an oil and gas investment to get a large immediate deduction to eat up some of the amount converted. So there's a lot of really cool strategies that if you're a client of IRA Financial, this kind of stuff we help you with and get you access to this type of education. So that's the second thing is, hey, can you afford the tax? Does this make sense to you? I would also say, thirdly, investment confidence, right? Going back to the example of the 85-year-old gentleman who has an investment in a private business that he thinks will go public or be bought by Google in a couple of years. How confident are you in your investment? If you're a really crappy investor and all you do is generate like 2-3%, maybe Roth conversions aren't that important because you may not be able to preserving that much tax-free wealth, right? Or if you just don't have a lot of confidence in what you're doing, maybe just staying in a pretax IRA may make a lot more sense to you. Fourth, like, how patient are you? Do you think you can trust the process, kind of stay the course? Or are you going to be itching to take distributions prior to age 59 and a half? Because if you are, you don't want to be in the Roth world, right? Because all you can be able to take out is the amount contributed. If you're going to need to tap in to the juice, the earnings on your Roth IRA contributions, I don't know if a Roth IRA conversion makes sense because just take the money out of a pre-tax IRA, take what you need, pay tax and a 10% penalty. But why pay Uncle Sam up front? And then maybe in 5 or 7 years, you're going to be stuck taking money out of this very valuable Roth and paying more tax on it. Whereas if you were patient and were able to wait till you're 59 and a half and the Roth was open at least 5 years, you can lock in tax-free growth on those funds. So you got to know yourself. You got to be patient. You basically got to lock this stuff away. Say, I'm just going to add money to it. I was at a conference a couple weeks ago in Dallas at an investor conference. And I was talking to an individual who was like in his 40s. And he's like, he wasn't married. He's like, Adam, like, this sounds good, but the Roth, I don't want to wait till I'm 59 and a half to pull the money out. I want to use it now and live. I'm like, well, it is for retirement. The only thing I could say to that is, listen, the contributions you put in, you can pull. So let's say you put in, as I mentioned, $5K a year for the last 8 years. That's $40K. You got to work with that. And each year as you put in more money, you can pull a little of that money out if you have some cash flow issues. But if you want to just pull all of it out to buy a Ferrari, then don't do a Roth IRA. I mean, what's the point of this? This is saving for the future. This is for you. It's for your family, for your children, as a legacy. This is not to just put it in this year and pull it out in 8 months to buy a Ferrari. There's no point in doing that. Right? Don't waste your time. You shouldn't even be listening or watching this video because this is about your future. This retirement system is literally rigged in our favor. Okay. People don't get it. And I keep saying it. It's based off 3 things. You got to start early if you can. You got to be consistent, keep making contributions. And just as important, if not more important, you got to be patient and trust the process. The longer your money's in the retirement system, the richer you're going to be. It's a general statement. More often than not, that is the absolute truth. Americans, we're amazing people. we live in the best country. We're the smartest. We come up with the greatest business concepts, but we're not very patient, and we enjoy consuming. So that's the hardest part when I talk to people is just put this away and don't think about it. Okay, just think about this as like a mini life insurance, but you're going to be able to use it when you get older. Okay, just like life insurance, you pay your premiums every year, and you're like, I hope I don't die, but if I do die, I know my family is going to be taken care of. Same thing. It's like, I hope I don't really need this money, but if I do when I'm 60 or 70, I'll have it. And if I don't need it and I pass, then my spouse will enjoy it. And if he or she doesn't need it, then our kids will use it. And if it's in a Roth, it will be tax-free to your kids. It's an amazing, amazing legacy to leave to your heirs, where you know they're not going to have to pay any tax on anything they pull out. So it's a really cool idea. I guess the fifth item to consider, and again, all this is facts and circumstances. If you're a client and want to chat about it individually, like, we're happy to chat. But ultimately, all we can do is kind of guide you and coach you. It's up to you. Like, your personal situation. People come to me and say, tell me what to do. And honestly, I can't, because I don't know every facet of your financial and family life. But another item I would say you want to consider is, are you going to need this money in retirement, right? And what your tax bracket will be, right? If you think you're going to be playing golf all day and just living off Social Security and kind of downsizing your life and not having a lot of expenses, kids are out of college, like, I'm just going to be relaxing, I'm a simple person, then maybe a Roth conversion doesn't make sense. Why? Because let's say you think your tax brackets, even if tax rates do go up in the next 20, 15, 10 years, you may believe that your tax rate will still be quite low because you're going to live a very simple life. So converting pre-tax to Roth today at a 24% or 30% tax rate, when your tax rate may be 15 or 18% in 15 or 20 years, honestly may not make a lot of sense for you. Versus, hey, I'm going to keep working till I die. I plan on having a lot of income. I got a lot of investments. I like to stay busy. Working's fun. I like making money. I'm going to probably be at least 24 plus tax rate, 30%. Who knows where tax rates are, but I'm going to be working. Then I think the conversion makes a lot more sense for those folks, because this tax savings by having a Roth at a later date in your life will have a lot more value and a lot greater tax savings, because your tax rate will be higher at retirement age there and beyond that, versus having a very low income level with a corresponding low tax rate when you retire. So that's something that I would suggest. The legacy is important too. How important is leaving a tax-free legacy to your family? Some people are like, I don't care. I'm giving my kids the money. They can deal with it, pay tax on it. Others, like myself, are like, no, it'd be even cool to know I'm giving them tax-free money. So it's like insurance, right? The insurance is great because you get a guaranteed death benefit if you buy term insurance or even whole or universal. In a lot of cases, you kind of know what you're going to leave them. And also the advantage of life insurance is you get it tax-free. Roth IRAs, you don't get a guaranteed death benefit. Although, if you run your numbers and assume you're getting a set percentage over 30, 40 years, you can get a really good idea on how much money you're going to have at retirement. Whereas life insurance it's guaranteed, but in both cases, it's tax-free, right? The only difference is life insurance, if God forbid you pass before 59 and a half, the insurance will still go to your heirs tax-free. In case we're Roth, you got to be 59 and a half, and the Roth open at least 5 years to pull all those funds out tax-free. So, I think I'm a pretty good, advocate for Roth. I wrote a book, In God We Trust, In Roth We Prosper. I'm not sure there's many people in the country that, have spent as much time as me thinking about Roths and Roth conversions. If there are, I'd like to meet those people. But, as a tax lawyer, someone who has their master's in tax law, someone who's worked at some of the largest law firms in the world, written 8 books, I think I'm, more than qualified to talk about Roth IRAs. And sometimes it frustrates me because I hear people giving advice on Roth IRAs that aren't lawyers, aren't accountants, aren't CPAs, aren't tax professionals. And it's like, kind of, it is frustrating because just like I don't give advice on, COVID vaccines or, should you have surgery? I think it's wrong and unethical to give advice on conversions or tax areas when you're just not qualified. So I think that's important to me. I try to speak what I know, and I definitely don't speak. You can ask my wife and kids. I definitely shut my mouth when there's areas I do not know. What's the downside of conversions? Okay, the downside of conversion is, here's a recent example. You own Silicon Valley Bank stock or bonds, as I did, and you decide to do a Roth conversion of Silicon Valley bonds or stock because you think it's a great company, it's going to keep going up, and a month later it goes bankrupt. And now you just paid Uncle Sam all this money on an asset that's worthless, all right? Whether it's Enron, whether it's Lehman Brothers, Bear Stearns, whether it's Silicon Valley Bank or whoever the next case may be. The downside is there's no guarantees, right? Even the example of the 85-year-old gentleman startup that he thinks is going to get bought by Google, who knows? There's a chance the company runs out of money in a year and goes bankrupt, and that 50K is worth zero. So the threat and risk of a conversion is you're converting at an amount, paying tax on that amount to Uncle Sam, and then if the asset drops in value, you've just paid Uncle Sam money for no reason. Because if you kept that asset, you may have lost your money, but you wouldn't have paid tax on that money as well. So that's the downside. The upside, I always tell, is you buy Bitcoin at 2000 and now it's worth 26. You bought Tesla 8 years ago for $10, and now it's worth whatever it's worth. You get it, right? You're able to put your carried interest in your private equity fund, your hedge fund, your real estate fund into a Roth IRA. You are Peter Thiel and you bought Facebook for $500,000, first investor, and turned it into $350 million in Roth. Or you bought PayPal stock as a founder and turned $2,000 into $28 million. Obviously, those are the golden age stories. Success stories. There's obviously horror stories, as I mentioned, the Silicon Valley or Lehman or Bear Stearns, where you paid a converted amount on a high value and now that asset is worthless. So obviously there's no guarantees in life, but you can also do conversions over time. Talk to people about that. You don't have to convert everything at once, right? So let's say you're 52 years old. You make a few $100,000 a year with your spouse, married, filed jointly. And you're like, Adam, I want to get that $100K into Roth, but I don't want to pay $30,000 tax on it. That's crazy. So I'm like, okay, take your $100K and do it over the next 7 years. Do whatever you have in your tax bracket to go up to and take more income in without paying more tax. Maybe it's 50, maybe it's 20, maybe it's 5. Do that amount every year for the next X amount of years until that $100K is all Roth. Okay, so now what you've done is you moved everything in Roth without increasing your tax bracket. Yeah, it's going to be some incremental amount of tax you have to pay, but maybe it's $15K a year and at 25%, maybe it's $3,000 extra in taxes. Maybe you got some extra deductions, some credits. Maybe you do some oil and gas investments, eat up some of the tax. So there's ways to minimize the impact on the Roth conversion. But again, I think the Roth conversion is the holy grail of investing. It's an unbelievable strategy because you can take advantage of timing, right? You can watch the crypto market, the stock market, the gold market, the real estate market. Let's say you have a real estate fund, it's getting hammered now, or hard money loan. You feel like the lenders may be defaulting. Maybe you can take a low value on this loan and then find a new borrower or take the collateral and get access to the house, sell it, and reap more benefits. So your investment. The valuations are kind of loose. You have to provide a value. You don't need to get Ernst & Young to give a value. There's a lot of good valuation companies, which aren't expensive. And you can even take discounted valuations. Yeah. What's a discounted valuation? It's basically an asset that's generally liquid, not cash. Stocks, real estate, things that you can't just sell, a minority interest in an LLC. And you can potentially get anywhere from a 25 to 40% discount on it. So if that asset's worth 100 and it's a minority interest in an LLC that no one's really going to pay fair value for it because they don't have controlling interest in that LLC, you'll get a valuation company that may say that it's actually not worth 100, it's worth 60 or 50 or 30 or 70, whatever that number is, and then you pay tax on that amount. Yes, the IRS doesn't have to accept the discounted value, but for the most cases. The IRS loves conversions. Okay, got one question. I'm just gonna end on this fact. You may think, why the heck would the IRS love conversions, right? Makes no sense. Conversions are bad for the government because in the next 10, 15, 20, 30, 40 years, they're not going to be getting any tax revenues from Roth IRAs, right? And now with required minimum distributions, they get approximately 3% a year on the value of IRAs. And there's $17 trillion in IRAs. It's unclear what's pre-tax or Roth, but majority is pre-tax still. So 3%, that's a lot of money each year that the IRS will get. That number, if the IRS keeps pushing people to Roth, which they are, that number is going to keep dropping and dropping over the next 10, 15, 20 years as people mature and take more money out. And that Roth individual owners over the age of 59 and a half. So you're probably wondering, why the heck would they do that? Well, the simple answer is governments don't really care what happened, and politicians especially don't care what happens in the next 10, 15, 20 years. Why? They're going to be gone. They'll be retired, living on a farm somewhere or in the States with all their stock gains. They're not going to care about the country or us. So it's important that they preserve deductions. Why? Because what deductions do is they lower the amount of taxable revenue that the government collects. And the more taxable revenue governments have, the more money they can blow on stupid stuff, which members of Congress and Senate love because they can earmark certain money to their pet projects. Right? Politicians, the more money they have, the more money they're going to spend. We should have a balanced budget. That's one of the areas that I'm like super upset with. And it's not a Democrat-Republican thing. Both parties have done a really bad job over the last 10 years spending. We're just spending way too much money. I think that's the biggest threat we have, bigger than the border, bigger than anything else, is spending. We have $3 trillion of excess deficit each year. It's a major problem with interest rates going up. We're going to be spending all our money just paying down debt. And I wouldn't want it as a business owner, and I don't want it as a citizen of a country. Will we be the next Argentina or Venezuela? Damn, I hope not. But we're not thinking properly. So that's my biggest concern. I don't know why I just said that, but bottom line is, we need to. Governments aren't always smart and they make stupid decisions. So that's why they love Roth. Could the government change the rules on us? Honestly, who knows? But 2021, Build Back Better, they try to put limits on Roths. They try to do some funky stuff. That didn't go anywhere, got kicked out, but it's on the shelf. I mean, who knows what another president. It only becomes an issue, really, and again, I don't want to get political, but it's really if the Democrats control the House, Senate, and government and presidency. When it comes to retirement accounts and Roths, I'm not saying they're anti-retirement. They're certainly supportive of the retirement system. They're not very pro large IRAs, Roth IRAs. So, yeah, I doubt that will happen. It doesn't seem very American to limit people's retirement, but who knows? The only last thing I'll say is before 1982, Social Security was tax free, and now it's subject to tax. So could the government change rules if they're in 10 years, we're spending all our money, interest rates are high, and we don't have enough money to pay our deficit? Can they just say, hey, sorry, guys, you just have to start paying tax on all your Roth money? Yeah, I hope not. I would be, I think we'd all be upset, but can you put it past anyone in Washington? So just be cautious of that. I have a lot of people. There's a mentor of mine that's been around the block, super smart guy, and he said he's not a Roth guy, and he said I just want my deduction today. I don't trust the government. I don't know what they're going to do. I don't trust them preserving my Roth, so I'm just going to grab the deduction. They can't go back 10 years from now and tell me to amend my return and take back my deduction. So I'm just going to grab it and deal with the tax down the road. I'm more trustworthy, for right or wrong. I've been burned before, but that's my attitude. And I just think personally, if I make a $6,500 deduction at a 30% tax rate, maybe I'm getting a $2,000 deduction. My belief is in my 40s, I'm going to do way better than a $2,000 deduction if I invest in Roth. When I'm 60, 70, 80, I'm going to have a lot more tax-free value than that $2,000 deduction I would have received today. So that's my play. It's a long-term play. Could the government change the rules on us? Who knows? Things get crazier every day in Washington. But again, it's not a Democrat or Republican thing. It's just a political thing. Who knows? I just ultimately think the reward outweighs the risk. I do. I think the ability to have everything tax-free in a Roth, the reward far outweighs the risk of the government changing the rules on us. I don't really see that as a viable option. I just think ultimately I'm a Roth guy. I'm a Rother, and I just think it's the best tax-free legal tax shelter out there. When you combine it with life insurance, if you have a big Roth and a lot of life insurance, your family is going to remember you very, very kindly. They may even donate in your name, put a nice big statue of you in front of their house because you're going to make them very happy by giving them all this tax-free money. So there you go. That's my tax attorney take. Hold on. I got a question here. Let me see if I can read it without my glasses. My employer allows in-plan backdoor mega Roth 401ks. Nice. And after-tax contributions can be rolled into a Roth IRA immediately. I also have a traditional IRA with this trigger pro rata. No, the mega backdoor Roth 401k, the reason it can be done is there's no pro rata rule. So that's why there's a notice that came out several years ago that said the mega backdoor Roth is not subject to pro rata rules. It's only for Roth IRA conversions. That's amazing. I actually was talking to a Wall Street Journal reporter maybe a year or so ago about this, and because she wrote an article about stating that upwards of like 20% of employers offer this mega backdoor Roth. And I questioned that. I said, I'm not sure how they can do that, because if not enough rank and file employees do the mega backdoor, which most don't because they don't even understand it, then if too many executives would do it, which generally would want to do it because they probably make more money and the backdoor has more value to them, they understand the rules, you're going to fail the top heavy contribution test as well. And the mega backdoor won't be respected. In fact, I have a friend, it's a true story, that did a mega backdoor, and like literally the company sent him a letter saying, sorry, we can't do the mega backdoor. We're going to have to give you back your contribution because we failed the test, and he lost the contribution. So John, if your employer allows you to do it, go for it. I mean, you can go 66,000 this year, 73.5 all in Roth, dollar for dollar, and then do the mega backdoor. And I'll do maybe next week or 2 weeks when I go live in 2 more weeks, I'll do it on the mega backdoor Roth 401k. John, great question. I'll explain how it works, but you literally can do it after tax to Roth in your 401k, and then just move it to a Roth IRA or keep it in your plan. And it's the best way to robustly increase and maximize Roth contributions on an annual basis and make up for a lot of lost time. Some people say, Adam, I'm in my 40s, 50s, like $6,000, $7,000 in a Roth. Like, who cares? It's not going to work. And I disagree with that. I think every dollar matters. If you make some good investments, even if you don't have millions, but you have hundreds of thousands tax-free, that's better than nothing. It's better than just saying, forget it, I'll just give up. But if you are self-employed or you have a business that allows for the mega backdoor Roth, you can go up to 66 or 73.5. Now you do that a couple of years, you're more than making up for any lost time. And you're talking now potential millions in a Roth IRA or 401k tax-free when you're older, which is, ultimately, those are the people I have the most respect for. I have some clients that have 30, 40 million plus, some 100 million plus in a Roth IRA. I look up to those people more than anyone in the world, truthfully, because those people are genius. Not only are they great investors, and that's why people may say bad things about Peter Thiel politically. He's a bad person. I don't know. To me, he's a role model. I look up to him and because he was smart enough. And actually, one of my mentors was the person that explained what a Roth IRA is to him. So back in the late 90s. So the fact that he made all these amazing investments in PayPal, Palantir, Facebook, and then did it in a Roth, like, you're the smartest person in the world. Forget about Warren Buffett. You're the smartest. So to me, that's the most exciting part, because you can be a great investor, take advantage of the holes in the tax code that allow you to do all these things tax-free. As I mentioned, it's literally rigged in our favor. The Roth IRA is literally the best legal tax shelter out there that we all could do. We just got to understand the rules, and that's why I do these videos, these podcasts, these blogs. I hope we all can learn from this and just be more tax savvy. Be great investors. I can't help you invest. I'm just a dumb tax lawyer, but I can tell you what the tax code says and use my education, my background to make everyone a better tax-free investor. So thank you so much for watching today. I hope you guys enjoyed it. Come back in a couple of weeks. I think I'm going to do the mega backdoor Roth 401k. John, great question. If people have ideas or comments, leave them. I look forward to hearing from everyone. I love getting comments. Hopefully they're all good, but if you got something bad to say, yeah, I'll deal with it. Goal is to always get better and provide better information, better content, and just do a better job educating people. So thank you all for hanging out with me today. I really appreciate it and hope you had an amazing day and amazing rest of your week. Thank you so much.